Welcome to the deep dive, where we take a stack of information and distill it into those crucial nuggets of insight for you.
Yeah, we try to cut through the noise.
Exactly. Today, we're cracking open Rossari Biotech's latest corporate disclosures. And it's a fascinating puzzle. We've got strong revenue growth on one hand, but then a noticeable dip in their consolidated profit.
Right.
So our mission today is to try and unravel why that might be. We'll start right from the recent board meeting, dig into financials, and importantly, look at the auditor's key findings.
That's the plan. We're diving into quite a captivating set of documents from Rossari Biotech Ltd, focusing on their board meeting outcomes from July 19, 2025.
Yeah.
And that includes their unaudited financial results for the quarter ending June 30th, 2025. Plus some interesting details about an employee share allotment.
Okay, great. And you've handed us the official filings to the stock exchanges, the detailed financials, and even the auditor's review report.
The whole package.
It's like getting a direct peek into the company's recent performance and, their governance. So let's unpack this and get straight to what you really need to know. Let's kick things off with the main event then.
Yeah.
The Board of Directors meeting. It was on Saturday, July 19th, 2025, started at 5:45 p.m., wrapped up just an hour later at 6:45 p.m. Pretty quick.
Yeah. Seemed quite efficient.
So what were the primary decisions that came out of this crucial hour for Rossari?
Well, there are two main items that got the board's okay. First, they signed off on the unaudited financial results. And that means, they've been reviewed internally and by auditors, but not yet fully audited. Gives us a good, timely snapshot, though.
Right, and it covered both angles.
Yes. Importantly, they released both standalone results, that's just the parent company's performance, and consolidated results, which paint the full financial picture across all their subsidiaries. These were checked by the audit committee first, then approved by the board, and then they underwent what's called a limited review by their statutory auditors, Walker Chandiok & Co., LLP.
Okay, so the financials were item number one, major item. What other key decisions came out of that board meeting? Anything about, say, company structure or incentives?
The second significant approval was the allotment of equity shares under the Rossari Employee Stock Option Plan, the ESOP for 2019. This is pretty standard practice for companies, really. Shows they're committed to long-term employee incentives, kind of aligning staff interests with shareholder value.
All right, let's shift gears then and dig into that employee share plan. What were the specifics? What exactly happened with this ESOP allotment?
Okay. So the board approved the allotment of 375 equity shares. Each share has a small par value, Rs2, fully paid up, and these went to an employee who exercised options they were granted earlier under that ESOP 2019 plan.
Just 375 shares.
For this specific approval, yes. But it's worth noting this specific allotment is actually built upon a larger sort of in-principle approval they got way back in May 2021. That older approval allows them to issue up to, I think it was 1.5 million equity shares under this same plan over time. So this is just one part of that.
Gotcha. So these new shares, do they function differently from the ones already out there? Are they like a different class or anything?
No. These new equity shares are designed to rank pari passu.
Ah, the fancy term.
Right, pari passu.
Oh.
It just means they're completely equal in all respects with the existing equity shares of the company. Same rights, same privileges, no difference.
Okay. And even though 375 isn't a huge number in the grand scheme, every share allotment shifts the capital structure a bit. What's the bottom line here for Rossari's overall share capital after this?
So after these 375 shares were allotted, Rossari Biotech's total issued and paid up equity share capital naturally grew slightly. It's now just over Rs 110.7 million. That consists of almost 55.4 million equity shares in total now, each still with that Rs2 par value.
Okay.
And it's probably worth noting, too, while these 375 shares were approved at this specific board meeting, the company also disclosed that during the entire quarter ending June 30th, 2025, the parent company actually allotted a larger total number. It was 2,825 equity shares under the same ESOP plan. So this 375 is part of that quarterly activity.
Right, that makes sense. Context is key. And for anyone interested in the, the nitty-gritty financial mechanics, what was the price? The price at which these specific 375 shares were exercised by the employee?
The exercise price per share was Rs 425, and that included a pretty hefty premium, 423 per share over the Rs2 par value.
Okay. Now, let's get to the numbers everyone's really keen to understand. The unaudited financial results for the quarter ended June 30, 2025. What was the overall picture for Rossari Biotech on a consolidated basis? So, parent company plus all its subsidiaries bundled together.
Right, the big picture. On a consolidated basis, Rossari Biotech saw its revenue from operations increase.
Hmm.
It went up to approximately Rs 5.44 billion for Q1 FY26. That's a pretty healthy jump from roughly Rs 4.90 billion in the same quarter last year. Works out about an 11% increase year over year.
Nice.
And their total income also rose from around Rs 4.91 billion to Rs 5.45 billion. So top line looks good.
Okay, so revenue growth, clearly positive, always a good sign to see. But, often the real story, especially for investors, is hiding in the bottom line. What did we see happening with profitability on that consolidated view?
Yeah, and this is where it gets interesting. Despite that solid revenue growth, the consolidated profit after tax, or PAT, it actually saw a slight decrease. It dipped to about R 336 million in Q1 FY26. That's compared to roughly Rs 349 million in the prior year's quarter.
Okay.
So it's a small decline, around 3.7%, but still a decline. This also reflected in the basic earnings per share, the EPS, which dipped from R 6.32 down to R 6.07 year over year.
Now that's the kind of, nuance we look for. Revenue up, consolidated profit down. My mind immediately jumps to the standalone performance. Did the core parent business show the same trend, or was it a different story there?
Well, you guessed it.
Mhm.
The standalone results tell a notably different story. Quite different, actually. Revenue from operations for just the standalone entity, the parent, increased to approximately Rs 3.66 billion in Q1 FY26. That's a significant rise from around Rs 3.01 billion in Q1 FY25.
Wow, that's a big jump.
Yeah, roughly a 21.6% increase. And unlike the consolidated figures, the standalone profit after tax actually increased. It went up to about Rs 262 million, up from roughly Rs 243 million in Q1 FY25.
Okay, so that's an improvement of what, around 7,
Yeah,
8%?
about 7.8% improvement on the standalone profit.
That's a really clear improvement on the standalone side then. And you mentioned earlier that this kind of divergence between consolidated and standalone performance often sparks questions about subsidiary contributions. So what specific questions should our listeners be asking themselves here, especially as we transition to looking at the auditor's notes?
That's a perfect lead-in. This leads us right into the auditor's review.
Yeah.
Walker Chandiok & Co., LLP, performed what's called a limited review of these unaudited results. Now, a limited review, you should think of it as more like a sanity check, maybe, not a full deep dive like an annual audit.
Right, less intensive.
Exactly. It mainly involves inquiries, asking management questions, and doing some analytical procedures, looking for obvious red flags, basically. The auditors aren't giving a full stamp of approval like in an audit. They're just stating whether anything significant has come to their attention that suggests a material misstatement, a big error.
Okay, so in that limited review, were there any parts of the consolidated results that Walker Chandiok, the primary auditors, didn't directly review themselves? Maybe they relied on other firms.
Yes, and this is where it gets, well, I'd say really interesting for anyone trying to understand the full picture. The auditors specifically noted they did not directly review the interim financial results of 4 subsidiaries and 1 associate company.
And were these significant?
Oh, yeah. These entities contributed significantly to the consolidated statement. We're talking total revenues of over Rs 3.6 billion and a net profit after tax of around Rs 116 million for just the subsidiaries, plus another net profit of about Rs 4.5 million for the associate.
Wow, okay, so how did the main auditors account for those numbers then?
Well, for these specific entities, Walker Chandiok's conclusions were based purely on review reports provided by other auditors. They relied on the work done by the auditors of those subsidiaries and the associate, not their own direct review.
Okay, that's important context. And what about segments that weren't reviewed by anyone? It sounds like there might be another layer of complexity here.
You're right. They also flagged something else. They highlighted 5 subsidiaries and 1 joint venture whose interim financial information was not reviewed by their respective auditors at all.
Not reviewed at all. So how significant were these ones?
Much less so, financially speaking.
Yeah.
These particular entities accounted for a much smaller total revenue, just under Rs 3 million. And actually, a combined net loss after tax of about Rs 10.75 million for the subsidiaries, although the joint venture showed a tiny net profit of Rs 0.64 million.
So unreviewed numbers, even if small. How did the auditors frame that?
Well, the report states this information was supplied by the holding company's management. And critically, it was considered not material to the group by the auditors, Walker Chandiok.
Ah, the not material caveat. So in their view, not large enough to significantly impact the overall consolidated picture.
Exactly. But still, something to be aware of, that there's a small slice based purely on management's figures.
Okay. We've picked apart the numbers, the standalone versus consolidated story, and the auditor's caveats, which, as you said, really underscores the complexity of a business with so many parts. To fully appreciate those financial insights, I think it's crucial we understand Rossari Biotech's underlying business. What do they actually do, and how is this global web of entities structured?
Good point. Rossari Biotech Ltd. Operates primarily in one core area, the specialty chemicals sector. That's their bread and butter. And interestingly, the company itself views this as a single operating segment. They argue the products, the risks, the returns, they're all similar enough to be grouped together.
Even with all those different company names we saw.
Apparently so. It certainly simplifies how they internally track and report their financial performance. Just one bucket, specialty chemicals.
Okay. But diversified seems like an understatement for their structure. It sounds like they've got operations spread out quite a bit. Can you give us a clearer sense of that network? The companies under the Rossari umbrella and their overall reach.
Sure. The consolidated financial results, the ones we've been discussing, they actually pull together numbers from a pretty broad range of entities. Let's see, you've got 3 foreign subsidiaries, Rossari Global DMCC, Rossari Bangladesh Limited, and Rossari International Company Limited.
Okay. International reach there.
Definitely. Then there are 2 step-down foreign subsidiaries. That means subsidiaries of their subsidiaries. Those are Rossari Biotech, Preeting FZE, and Unistar Tyco, Ltd.
Getting complex.
It is. And then on the domestic front, here in India, they have 4 Indian subsidiaries, Unitop Chemicals Private Limited, TriStar Intermediates Private Limited, Boozle Rossari Private Limited, and Rossari Consumer Products Private Limited.
Right.
And finally, the consolidated picture also includes an associate company, which is Romac Chemicals Private Limited, and a joint venture, Hexstar Unitop SDN, BHD, based in Malaysia.
Wow.
So yeah, this extensive network really illustrates their diversified operational base. They're spread across different geographies and probably different niches within that broader specialty chemical sector.
Okay. Pulling all these threads together now, that financials, the ESOP, the structure, the auditor notes, what are the critical takeaways for our listener, whether they're an investor, maybe just tracking the market, or keeping an eye on the specialty chemicals sector generally? What does all this mean for them?
I think this deep dive reveals a company that's definitely dynamic. On one hand, you see that solid revenue growth in the last quarter, both for the core standalone business and the wider consolidated group. That's positive. However, that slight dip in consolidated profit after tax, especially when you contrast it with the improved standalone profit, that's a powerful signal.
A signal of what exactly?
It tells us that while Rossari's core operations seem incredibly robust, their strategic expansions, maybe acquisitions, maybe joint ventures, particularly those less directly scrutinized by the primary auditor, those are the real swing factors right now, impacting the overall bottom line. So for you, the listener, this means digging into the performance of those specific subsidiaries and joint ventures, the ones perhaps reviewed by others or not material enough for review yet. That'll be key to predicting the company's longer-term profit trajectory.
That makes a lot of sense. You need to look beyond the headline consolidated number. And what about the ESOP allotment we discussed earlier? Is that a major factor?
The ESOP allotment, well, it was a small number in this specific instance, 375 shares plus the larger quarterly amount. It mainly just confirms the company's commitment to employee incentives, fostering growth from within. For an investor, it shows that alignment of employee interests with shareholder value. It also, of course, slightly increases the number of outstanding shares, causing a tiny bit of dilution. But overall, it's a normal part of how a growing company manages its talent, not a huge needle mover in itself.
Got it. And the auditor's notes on the limited review, you highlighted how insightful they were. They really add a layer to understanding the full picture, don't they?
They absolutely do. Understanding that a significant chunk of the consolidated results relies on other auditors' reviews, and that a small portion, even if deemed not material, isn't reviewed by anyone externally, that provides crucial context. You have to take the consolidated numbers with that grain of salt. It just underscores the inherent complexity of financial reporting for these big multi-entity businesses like Rossari Biotech. and it highlights areas one might want to look at more closely in future reports, see where the financial heavy lifting is actually happening within the group.
Well, we've certainly taken a deep dive into Rossari Biotech Ltd's Q1 FY26 results. We've navigated through the financial figures, the corporate disclosures, the structure. It's genuinely fascinating to see how a company's overall health can be such a mosaic of different performances.
Absolutely. This discussion really highlights how individual financial statements, especially when you combine them with the regulatory filings and those crucial auditor insights, offer a much, much richer understanding than just looking at the headline number. It's really about piecing together the full story, warts and all.
Definitely. So, as you, our listener, reflect on all this, consider this provocative thought. In a complex global business like Rossari, where the primary auditor isn't looking directly into every single corner, what subtle shifts in those unreviewed or externally reviewed subsidiary or joint venture performances, even the ones currently deemed not material, what could those shifts signal about important future trends or maybe even hidden risks for the larger entity down the road? Keep asking those deeper questions.